Okay, so we're going to look at this as we're starting our day trading, right? And we're trying to map out our market structure. That's the main thing that we're trying to learn right now is market structure. And once you get it, it's really simple to a degree, but the thing is a lot of people, one, they get it wrong. And the difference why they get it wrong, in my opinion, is what I call relevant market structure. Like what I was saying yesterday, you can have multiple levels of major swing structure, but it doesn't mean that they're all really relevant. It doesn't mean they're all as important as the next or the one prior, So that's why I call them relevant, because they're the ones that are the confines of our move. Like they are the high we need to gain and the low we need to lose. And at any given point, we expect, or at least the probabilities are in our favor, to either gain the high or lose the low. That is going to be determinant on if we're in a downtrend or an uptrend. So for instance, if I do a little drawing here to illustrate that point. All right. So right now we're in an uptrend. Okay. Now, market structure, we're looking to map the major highs and lows. Okay. So at this point in time, when we're right here, all right, say we're right here and this little impulse move up. So we're right here. So right now, that is our high. Let me mark that like just white. And then let me mark another one. And this is our low. Now, these are our relevant highs and lows if we're like right here at this point in time, right here. Okay.
Yeah.
Now, because we're in an uptrend, when this high broke the previous high, which would be back here somewhere, you know what I mean? So when that, it did its job. It did what it was supposed to do. So we're still in an uptrend, right? So we have a pullback. As soon as we make a higher high or lower low, we can always expect a pullback. When is it going to happen? There's things further along that we'll talk about that will kind of help us determine when that might happen or should happen, So at this point in time, we expect this high right here. We expect that high to be weak because it did what it was supposed to do. And when it made a low, because it's very important to recognize what did this high or low, what did it achieve and what did it create? Well, it achieved breaking the previous high and it created a low that did not do that. It did not break the previous low, right? So this was success. This was failure. Okay. So if let's duplicate this here. Oops. Let me clone that there. So if I clone that there, and then let's change that one to red. All right. So this we should expect to hold as strong, right? This one we should expect to lose it because we're in an uptrend, right? On this time frame. It's very important, this time frame.
Yeah.
So as it comes down, creates its low, and then comes up here, we're more than likely on smaller structure, more insignificant or lower time frames, we're going to see a reaction when it hits this, right? But we're not expecting that reaction to kind of like move it down. So, we have internal structure, which is not major, right? This is just like the internal or fractal little moves within bigger moves. So it may come up, right? And it may do this. And then it may just kind of keep doing this. And then boom, 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 and boom, and so on and so forth, right? So yes, it had a reaction here. And if this was a daily time frame or a weekly time frame, we certainly could have traded that, right? We could have traded it hitting this high and having a little pullback in here, because I mean, heck, this may be 1, 2, 3% in here, depending upon the time frame. But overall, we expect this high to be lost because this low didn't break its previous low, and it broke its previous high. So therefore it's weak. I know it sounds kind of counterintuitive, but just think about it as like opposites, and because this low did not break that low and change trend, since we're in an uptrend, if it didn't come down and break that, it didn't change trend. We're still on an uptrend. So the best thing we can do is count on that trend continuing. And the higher the time frame, the more that stands true. So if it's a 1 minute, like, I mean, they're going to flip flop back and forth all day long, right? Uptrend, downtrend, uptrend, downtrend, back and forth, back and forth, back and forth. A daily is going to take much longer to play out, and it's more than likely not going to go from an uptrend to a downtrend in the next swing high or low. So we expect this high to be lost because we're in an uptrend. It did what it was supposed to do. We expect this low to hold if this move were to come up and then come down. And it may bounce off of here, what Sean would call a backside level, right? Or it may come all the way down to here and test really greedy down in that swing and then still move up, right? But as long as it doesn't lose this, meaning close below it, then we're still good. We're still in an uptrend. But that can also signify to us how much strength is left in this move. Again, it's not 100% certainty when it happens, but it's a good, it's a general good rule of thumb to use and follow. And we'll get into the premium discount thing to really help discern that later, but I don't want to overcomplicate it for right now. But let's just say for right now, it comes up and it holds, this previous high right here, comes down and it bounces off of that. Now, the same thing is going to hold true, but in this area right now. Okay, because let me erase this little internal structure right there. All right, so at this point in time, we just broke this high, okay, like a candle closed above it, and we wait for it to come up and we wait for it to have its pullback. And that's what I was talking about yesterday about the criteria in which we want to look for to determine what is a pullback on that time frame. Do we go by candles in a row? Do we go by percentages? Do we just go by like what looks like a high and a low, a peak and a valley, right? Yeah. There's many different ways to look at it, and we'll go over that in the near future, but let's try to keep it simple and on target right now. So once this happens and we have that pullback, and then it starts to go up, now we know, all right, now we know we have a new relevant high and a low. So what we do, or this is the way I do it, a lot of people that teach market structure do it a little bit differently, just the way in which they market. And I don't personally think it's as beneficial or easy to utilize as the way I do it. I mean, just speaking for myself, but the way in which I do it is when this breaks that high and has its pullback, what I want to figure out is I want to figure out what was broken. It was this, okay? And then what broke it? It was this. So if I take a box right here and I start a box there, and then I put my other part of my box there, and then I grab that and I just bring it down, right? So what is the lowest point between what was broken and what broke it? It was this, right? So that is still going to be my low. Now, my high is going to be what broke it? Well, this broke it. So that's my new high right there. So this is my new relevant high. This is what I need to gain to continue the uptrend. And this is still what I need to lose to reverse trend, right? But this is still strong, and this one is still weak. So we're expecting this one to be lost or gained rather. And we're expecting this one to hold. So it can come here, or it can, again, it can even come all the way to here. And as long as it doesn't close below that, we're still in an uptrend on that time frame. All right. Okay. So now let me add a little bit more information to kind of illustrate a little bit deeper of a point here. Okay, so that broken. This back here. Okay, that. Yeah, there we go. I'll see. And then this. Okay. Yeah. Now I got it. Okay. There we go. Okay. So now let's just pretend this is where we're at in the move. Okay. This was our low that we needed to lose to change trend and go into a downtrend on this time frame. This was the high that we needed and expected to gain to continue that uptrend. So we have this pullback, comes down, it holds something in here, and it moves up, and we gain that high just like we thought we would. And then it comes up, and then when it breaks a high, like a break of structure, we expect a pullback. So it comes down, it pulls back, it loses this low, but that means something, but it doesn't mean what this means. This was the high that's really determining our trend direction. Okay. So we could come all the way down to here, all the way down to there. And as long as we don't close below that, we're still in an uptrend. All right. Now we're going to learn about what this means later, but I don't want to overload you with information right now. So at this point in time, we're going to do the same thing that we just did. All right. So this was what needed to be broken, or what was broken. I'm sorry. And this is what broke it. So we do the same thing with our box, right? We draw our box there, and then we go to what broke it. And then we pull the box down like that. Now, what is our lowest point in between those 2 points? It's there, right? So now our new relevant low becomes this. Okay, so now we can move this little guy there, and then our new relevant high becomes this, what broke the previous one. So we move that to there. And let's get rid of that little box. Okay, so now this is our relevant low and our relevant high. Now this right here, this very well may be just a wick, right? And that's kind of important. Like what's important is looking for candle closures, not hard closes, but the body just closing below levels. Because if I have this level here and this just comes down as a candle and it wicks it like really fast, like it just comes down, it wicks it, and then shoots back up real quick. I didn't lose that level, not on the type of mapping that I recommend to use. It means something, but it doesn't mean what we're focusing on right now, which is our overall trend direction.
Yeah, that was a question I was going to ask you actually. So it doesn't matter if the wick goes below that low, as long as the body doesn't.
Yes, the way in which I look at it, right? And I look at different time frames a little bit differently. Like, so some of my really low micro time frames, like 1, 3, 5, maybe 15-minute, but usually just 1, 3, and 5. I'll consider wicks a little bit more. For what we'll talk about is called a change of character, and that's basically the first sign of something changing, a trend direction. But I like to look for candle closures. They're safer. You may miss some moves, but a lot of these guys in Forex, Forex moves like 1.5% in a day, whereas crypto moves, 5, 10, 20, 30% in a single day. So we can't look at those two asset classes the same, right? Like they're not the same. More volatility means you need to adjust the way in which you kind of map things. So you have type 1 and type 2 mapping, is what they call it. Let me erase this. Oops. And that. And there we go. All right. So, and let me go to chart. It'll be easier. Okay. Let me just find some levels here. Okay, just that one. Okay. Here's one. Here's this one. And then we can use this one. Okay. So this one, color purple. Now I'm gonna leave white. So for the I believe it's type 1. God, I forget the type 1, type 2. I think it's type 1. But it doesn't really matter like what it's called, type 1, type 2. It's like a moot point, basically. One way to map market structure is to look for wicks, and then the other way is to look for candle closures through a level. Okay.
Yeah.
So if this was my level, I'm not saying it is, I just arbitrarily marked it, but if this was the level that I needed to, lose or gain, that right there is a candle closure. Okay. As soon as this candle closes, that tells me that's a closure, right? It's closing through it. Okay. Now, the alternate way, and the way in which I don't really use unless it's like a 1, 3, or 5-minute time frame, is this right here. So say this was my level, and then you see right here, you got a wick, a wick, a wick, a wick, and then bam, you have like a little bit of a candle close. You know what I mean? So this would be the other form. So some people may see this wick and be like, oh, okay, well that means I need to look for a trade in here. And sometimes that works out, but it's risky. It's a lot more risky than looking for this right here. So if I'm going to look for a short, see this happen, I'm going to look for a short in this area, right? And I can hit this short and then bam, and I could have taken profits, and I could have kept riding it out and just kept taking profits out along the way. And if I took this, right here, when it wicked it right there, and I'm like, all right, well, that means it's going down. So I'm looking for a short in here, and it's like, I mean, maybe I would have gotten it, maybe I would have gotten stopped out here, and then it goes down, and then it comes up, and eventually it loses it, but then it loses it again. So it's all about safety and risk. What are you willing to risk, really?
So the wicks then, when the wicks are kind of hitting that level, but they're not breaking through, that means we're going back down again. Is that what you're saying?
It is the first indication that we are okay. So in this instance right here, let me remove this here. So in this instance right here, if I were to look at this type of mapping, I would see that it wicks this level right here. And I would be like, okay, well, if I use that type of mapping, I'm going to look for longs. Okay. So I could look for a long, anywhere after this point. That's really going to be dependent upon a lot of factors, I mean, a lot, but let's just kind of put it roughly speaking. So if it wicks it, just like how Sean teaches, like, oh, it hit the break level, that means it's going to move up, but not always, right? That's what he would always say, which is true, but the way he would word it was, poor in my opinion. So if we were to go on that type of mapping in crypto, it wicks it, and we're looking for longs. Like, I mean, we're getting chewed up and spit out, right? Like we're trying to take longs in here, and like maybe we got a little long in here, like we decided to take something here, and we longed it, and we should take profits in there, of course, but maybe we didn't, like most people don't. And it comes up, and we're like, oh yeah, that's it, we're doing great, and then like it comes down, and we lost it, right? Whereas like if we look for candle closures, that can give us a much better insight as to what we should kind of do, because in this instance here, let me remove this white one. In this instance here, we're on the bottom side, so we've seen this candle close through that level. That was what we needed to lose to continue the downtrend. So at this point, we're like, all right, I want to look in here, because this is where it was lost. This was what was lost. So right here is definitely where the short's at. Okay, going by that type of mapping. And you can see it comes up, and you can get a really, quick entry somewhere in here, probably something in this. But even if you wanted to take something a little bit safer and take what was actually lost, you could have taken it there for a short. And let's say you wanted to get really greedy, and you really didn't want to risk a lot, like you could have taken, this in here, this hold, or what you would call this break, however you want to frame it, right? Or I mean, there's lots of different ways to look at it, but this was the better play, right? Being a little bit more patient and waiting. And it all started with this candle closing through that level that we needed to lose to signify that we were continuing our move down. But if we went with the wick up here, that was, if people use the wicks, they're like, oh, we wicked this level, so we should be moving up. Now let me look in here for longs. And yeah, you catch a long in here, and then it rejects. Maybe you took profits, maybe you didn't. And then it comes up, and you're like, all right, yeah, I'm in the money, and I'm bouncing off of it now, and then you lose it. So yeah, you could have taken trades in there on that for sure, especially on the daily. But was it the optimal play? No, it wasn't, because waiting for this candle closure and looking from the short, because we're in an obvious downtrend, right? We don't want to trade against the trend, especially not for our big trades or our long-term trades or anything like that, we can trade these little impulses, counter trend. Of course, we just need to adjust our expectations, and we need to know like what we're looking for, and not get too greedy with them. Like get in, get out, take profits, which you should do on every trade. Sure, some trades you may make less by taking profits because you're taking, let's say, a $10,000 trade, and you take profits and you take half off. Now you're in a $5,000 trade. Oh, it dumps down 5% more. Yeah, if you would have left it all there, you would have made more money. But more times than not, it's not going to do that, right? Like it's going to come down, it's going to move back up or back down. You're going to get stopped out. You would have lost, you would have got stopped out, and you would have not taken any profits. So it's more about like what we do over the long term. It's not what we do in each individual trade. Like that's really important.